Picks Show. And my special guest today is the reverse mortgage manager of a large national lender. But we've changed his name in order to protect him as he shares this non-private public information with all of you. Mike, as we'll call him, has been in the reverse mortgage business for the better part of 2 decades. Mike, welcome to the Rick's Picks Show.
Hey, Rick, thanks for having me.
Well, Mike, whenever I have the opportunity to have someone on the show with your level of expertise, I like them to participate as a subject matter expert in one of my segments. And I'm thinking for you, the Rick's Picks Top 5. Are you up for it?
Let's go, man. Sounds great.
All right, Mike. Here we go. These are the top 5 reverse mortgage myths on today's Rick's Picks Show. That's the top 5 reverse mortgage myths. And here are the top 5 reverse mortgage myths. Number 5. If I can't make the payments, you're going to take my house. That doesn't seem right. Mike, can you set the record straight here?
Yeah, absolutely, Rick. So the big draw with the reverse mortgage, the HECM reverse mortgage, it is you have no monthly mortgage payment obligation. Now, Rick, if you wanted to make a payment, you can. Maybe an interest only, something to that effect. You can make that payment. Keep your tax deduction, but you are not required to have a monthly mortgage payment. That is the number one draw to the program. You are, however, responsible for other obligations, right? You must maintain your property taxes, hazard insurance. You must be your primary residence and just general upkeep to the home. So as long as you do those, Rick, nobody's coming knocking at your door and kicking you out of the house.
Excellent. Thank you, Mike. Number 4. You lenders are all vultures. You foreclose on widows. Ouch. I know that statement has to be coming from a place of pain from someone, but even so, that's a bit rough. Mike, if you want to skip answering this one, I would fully understand.
No, absolutely. I want to take this on. So basically, the program did have some problems. A lot of changes over the years since I've been here, the 17 years. But one of the biggest things that was an issue was non-borrowing spouses. We call them that today. But back in the day, Rick, a spouse, if they weren't of age with the HECM loan, then they couldn't be on the loan. They couldn't be on title. So let me give you a quick example. You have a 70-year-old married to a 55-year-old. Back in the day, we just do the loan on the 70-year-old. Now, fast forward a couple of years, he passes away. Well, the reverse mortgage loan is now due. So this poor woman just lost her husband, this widow, and now the reverse mortgage is due and they're foreclosing on her. So what they've done now since 2015 is called the non-borrowing spouse. We recognize that spouse. If they're not of 62, they're still on title. They're recognized. So if something happens to that HECM borrower, as long as they're still married, she's living in the subject properties or primary residence, property taxes and hazards are current, she can maintain occupancy in the loan until she basically passes away or leaves. Now, one thing to notate, Rick, is she's not a HECM borrower. So if there's money on the line of credit or anything like that, that will be frozen. She will not have access to it. She could possibly refinance if she wanted to get some money, but she is not foreclosed on, and she does maintain occupancy in the subject property. So we have corrected that main issue as an industry.
Well, I have to say, I am so glad the industry has righted itself from that time until now. Number 3. All the reverse mortgage fees are just too expensive to make this worthwhile. Mike, what about the fees?
Yeah, there's some truth to it, Rick, and some non-truth to it. There's different sides. So some people that are in the reverse mortgage business say, hey, look at all the value you get. You get so much in comparison to what, right? And so from a consumer standpoint, I do understand the sticker shock. And the main issue, Rick, is the upfront mortgage insurance premium. And it's based upon the appraised value, or what we refer to in the reverse mortgage industry, the max claim amount. And, a traditional FHA is based upon the loan amount. So the reverse mortgage community is working on getting that corrected. If we could drive that down, that would tremendously help the value and avoid some of the sticker shock that we see on the closing cost side. The other fees, Rick, that are associated with the loan pretty much fall right into place. There's an origination that can go to the originator. Doc is usually, $150, give or take. Obviously credit, and then the other associated title and closing agent fees that you would see on a traditional transaction.
Okay, that's super helpful. Thanks for breaking that down for us, Mike. Number two. So what if you can pay off your mortgage, take cash out, pay off other debt, and skip future monthly mortgage payments? It's still basically a one-trick pony. One-trick pony, Mike. What do you have to say about that?
That's crazy. I mean, once you understand this loan, you fall in love with it. You really do. It does take a little bit of time to fully understand it. It is complex, but it carries a lot. So let's talk about the number one reason, right? No monthly mortgage payment. Okay, we already talked about that. Having somebody get out from underneath that monthly obligation is a game changer for them, especially seniors that are living on fixed income, pension, Social Security, things like that. Not being able to make those monthly payments, credit cards, running those up. We're seeing high credit card rates, upwards of 30%. People with great credit are still having credit cards at 25, 30%. So all of these factors coming into play in a reverse mortgage, being able to solve these problems, cash out, debt consolidation, no monthly mortgage payment is, to call it a one-trick pony is absolutely egregious. And then, Rick, the other feature, the credit line growth rate, money that's rainy day money is actually getting bigger and it's guaranteed for them. When borrowers really fall in love with the reverse mortgage program, Rick, is after about a year of being in it and they've seen it and how it's worked for them and changed their lives. That's when they come back and they're like, hey, Mr. Loan Officer, thank you for putting me in this thing. This has been phenomenal. And when they talk to their friends about it, Rick, back in the day, people wouldn't talk about getting themselves a reverse mortgage, right? It was taboo. Nowadays, guys are out, playing golf with their buddies, and they're like, you need to go get one of these things. My only regret with this loan program is I didn't get it earlier.
Wait, what? That's crazy. Mike, say more about that credit line feature.
Yeah, absolutely. So, with the reverse mortgage, we come in, we pay off what's referred to as mandatory obligations. So that would typically be the mortgage. If you have a traditional mortgage, maybe a HELOC on there, any liens on title for that fact, and closing costs. And then the remaining money can be drawn a number of ways. You can take some cash out at closing. You can set up a payment plan. Most folks take a little cash out at closing, then put the remainder on a line of credit to access at a later date. And what happens with that money, Rick, is that it grows, it gets bigger. And that rate that it gets bigger at is the same rate as the interest being charged for the money borrowed. So that's the interest rate plus the MI. And so the credit line growth rate, wonderful things are happening. Number one, it's not being added to your loan balance until you draw on it. Number two, there's more money tomorrow than there is today. So the borrower is incentivized not to pull it out. And you know that it's going to have more money on it and it's going to grow and it's going to compound. And then the last thing about that, Rick, that money is tax-free, okay? Because it's a loan, it's an extension of credit. So a lot of our audience members are probably thinking, oh, so it gains interest? Well, interest is income by definition. So conceptually, you can think of it that way, but it's an extension of credit. And that's very, very important because that's the reason why it's tax-free.
Well, that is fantastic. And the number one reverse mortgage myth in America today: you can't always get what you want. Mike, any idea what that final myth was about? You can't always get what you want?
Not really, no, but I'll take a stab at it. Okay. So, one of the cool things with reverse mortgages is, from an LTV standpoint, if you qualify from an LTV standpoint, and once that hurdle is addressed, then getting the loan through underwriting typically gets done at a very high rate. Okay, so once that appraisal goes through and you have the value, from a credit and income standpoint, if your borrower has some scratches, some issues there, they don't necessarily disqualify the loan. What ends up happening is the lender will impose a LISA. It stands for life expectancy set aside. And basically what that does is that transfers some of the borrower's proceeds over to the lender, and they'll be responsible for this duration of time to pay the property taxes and hazard insurance on behalf of the borrower. So you can call it a safety net. It's not guaranteed, Rick, but I'd say about 95% of the time, it does, if the borrower is short from a qualifying standpoint, that LISA is imposed, they can still get the reverse mortgage loan.
Yeah, awesome. Thank you, Mike, and thanks for being on the show today.
Yeah, thank you, Rick, for having me, and we look forward to coming back again sometime soon.
And that wraps up another Rick's Picks. If you have any questions on what we talked about today, don't hesitate to reach out. I'll be glad to help in any way I can. Thanks for watching, everybody, and start thinking about reverse mortgages for your eligible clients. Have a great week, and I'll see y'all next time.